With all of this and with just exactly how contorted the Treasury yield curve is, I mean, the stock market's better than flat for the week. It's not too far from where it was before the Fed actually did what it did. What's your read on that? I mean, what is the equity market sort of feeding off of, or maybe what is it ignoring?
Well, first, I think it's feeding off of technology and comm services, which is 35% of the weighting in the S&P 500. Those two sectors have done remarkably well year to date, both up double digits, far superior than any other sector year to date. So I think a lot of it is that, because there's a big chunk that has done really, really well. The other part of it is I think we're kind of looking through the banking issues. I am on record, and I'll say it again, I think the three failures were three of very problematic banks to begin with. And I think the market's seeing that, right? I think the market knows that CS was in a world of hurt, unprofitable, and had very little capital because the capital requirements were so much less over the last 15 years in Europe versus the U.S. banks. We know that Silicon Valley Bank had the mix issue with VCs. We know Signature Bank had the mix issues with crypto. And so those are kind of one-offs. Are we going to see more, Mike? Yes, we are, likely, but we're not going to see it at the big guys. And I think today specifically, Deutsche Bank is not CS. And I think that's what the market is looking through. It reorganized in 2019. It's been profitable. The solvency and liquidity ratios are fine, better than fine. In fact, by the way, profitability, 10 last quarters of profitability. So this is a different story. And I think that UniCredit backing their AT1 bonds this morning, I think was also a sign that the Credit Suisse issues were really more specific. We'll see, Mike, but I just think that the market is looking at these two things, and that's why it's hanging in there.
And so as you look at the movement within the market, Steph, in terms of, look, we had a great run for industrials and some consumer stuff at the start of this year. A lot of that's fallen back to a degree. Has it surfaced any particular types of opportunities, or would you still, I don't know, go with what's working in the moment here, which is kind of mega cap defensive stuff?
I think you want to have a balance. Last year, I was definitely leaning a little more value and more cyclical. I still want to have some of that, because I think some of the cyclical sectors are actually doing okay, and it's very stock specific, of course. But I think some of the banks down here, as I just mentioned, I think you have a lot of these one-offs here. I think Bank of America is very interesting. I picked up Schwab for the first time in a couple of years, given its 30% decline. But at the same time, I'm trying to pick up a couple of other names, maybe a little more defensive in a TJX and in a Keurig Dr. Pepper or in a GE HealthCare, which, by the way, has been a really great stock, but I think it has a long tailwind ahead of it. So I think you could kind of have almost back to the barbell that I had 2 years ago. I kind of want to see that. But today was all safety sectors for sure. Staples, healthcare, utilities. I get it. I understand it. But I'm not sure I want to go that defensive at this point in time.